Okay, so we had an interesting first week of 2016 in the stock market. So I want to give a market commentary. This is going to be part one, and I'll do a part two because I don't want this to get too long in the tooth. So let's talk about the global situation of what went on Monday, January 5th. The Chinese stock market was in full meltdown, and they had to implement their circuit breakers, which means they basically stopped trading for the individuals, and then they did this again on Wednesday. Now, something you have to understand, 90% of all the stocks traded on the Chinese stock exchange are by individual investors. Individuals. Now, that's very different. We have a lot of individuals in the U.S., but the U.S., there's a massive institutional presence, right? Lots of, our market often is driven by the institutions. So what everybody's focusing on is this right here. The global economic slowdown. Now, Europe has already waved their flag. They're already saying, hey, we're in slowdown. We are doing our own quantitative easing. We're admitting it. Things are difficult. Now, everything in China is secret, right? You really can't tell what's going on. So you have to look at other things that point to it. And this one, individuals moving their money, is one, but also the big one that everybody's been focusing on most of 2015 is commodity prices that have actually just absolutely gotten slammed. So this is a great consolidated chart. It shows all the different assets, what they did in 2015. So it's all color coded here. So you can see the dollar was the dominant asset. That's this red line here. And you look at the NASDAQ, right? You can thank some of the high techs, the FANGs, right? So Facebook, Amazon, Netflix, and Google, you can thank them for this performance on the NASDAQ, and everything else kind of got them bottoms out. But let's look at well, first of all, I'll point out gold and silver. They had a struggle in 2015. I have other videos that I talk about that. But let's look at the key commodities that are drivers of economic expansion. China is the second largest economy in the world. They do all this building. So let's look at the stuff they use for building things. Here's aluminum, down nearly 20%. Copper, down over 20%. Lumber, down 25%. Iron ore, down over 30%. So because China doesn't give us a lot of information, we have to look at these other indications to find out really what's going on. Here over in the United States, we have this trifecta of the White House, the sycophantic media, and the Fed that are all trying to convince us what? That we are in full-blown recovery since the 2008 meltdown. So 1 week of trading does not a year make. We know that. In the December alert, I talked about trends, and that in 2015, the S&P was basically down 0.7%. So that was trend less. We didn't have a trend to go on. The other thing I pointed out is we've never had 2 trend years in a row. So we're going to have a trend, and it's either going to be up or it's going to be down. I believe by the end of 2016, we will have a significant downturn, but it's a race. There's a race going on. It's a race between this slowdown, this global economic slowdown, coming this way, coming to our shores, hitting our shores. It's a race between that. And just remember, we got all this influx of refugees going in Europe, which is just exacerbating this problem. So it's a race between the slowdown hitting our shores and the money hitting our shores. Remember, supply and demand. If money comes our way, it'll drive our markets up. What money is going to come? Well, you have 2 components. These individuals that are taking their money out, they're going to put it somewhere, right? They're taking it out because they don't have confidence here. And the United States is still the best bet for them to do that. The same thing's going on in Europe. I've written about this in the alerts. If you put your money in Switzerland or in a Swedish or Denmark bank, right, you have to pay to have your money put in there. So the quantitative easing, what's going on in the central banks in Europe is they're trying to force people to take money out of their banks to do what? To start a new business, to expand their business, to hire a new employee. Well, would you do that? If you're facing this economic slowdown in Europe, would you take your money out and do that? No. Well, and these people aren't either. So they're going to take their money out and the money's going to flow. So it's this race between what hits our shores first and most significantly. The slowdown economically, meaning as we get our yet another round of earnings seasons, of quarterly earnings, and people continue to lose confidence that we are not in this recovery, that's the race between money coming over here, having to go someplace and driving our stock markets up, or the slowdown. Because at the end of the day, we are still driven, and I hate to say this, we are still driven by the Fed, right? So the Fed, we're on this teeter-totter. In December of 2015, the Fed raised rates, and there was an indication they're going to do it 4 more times in 2016. If they do this in a non-recovering global economic slowdown, then we are heading toward deflation and depression. And I wrote a position paper in June of 2015 on deflation, inflation, 13-page document. If you want to read that, then just contact us at thebrinkmanacademy.com. We'll send that to you. Or you're going to start hearing a lot of this dry powder talk concerning the Fed, meaning that they raise rates and now they can lower rates. Well, if they do that, then we're just going into ultimately hyperinflation. Now, I did a whole video just on this called Money Supply, so you can look at that at the brinkmanacademy.com and watch that whole video on money supply. I don't want to go through that right now. The third option for the Fed is this one and done. I don't see how likely that's going to happen. But ultimately, at the end of the day, something has to happen. Something has to happen to the $19 trillion that the Fed's put in our system. Something's got to happen to that. And I'm going to talk about that in part 2 of the different options of what's going to go on in the markets. Okay? All right. Thanks for watching.